Thank you very much, Richard. I would also like to have a crystal ball, if I can find one. First of all, let me say thank you very much for taking the time to be here this morning. It's very heartening to see so many people here on a Saturday morning. My presentation today will be really broken up into three parts. I will first talk about the macroeconomic outlook, and then I will talk about what the outlook means for the markets, and then finally I will talk about what that means for investment strategy and for your investments. So let me just start by showing you what we think the world economy is going to grow at. We see the world economy growing at only about 3% this year and only 3.2% next year. Very unimpressive, very unspectacular. Essentially I think the world is still reeling from the aftershocks, the after effects of the global financial crisis. We have gone from crisis to crisis, from problems to problems since 2009. We started off with the global financial crisis, and then we moved on to the European debt crisis, round one, and then 2012, European debt crisis, round two, and then 2013, we had taper tantrums after Ben Bernanke warned about, tapering down the QE program, and 2014, we had emerging market currencies plunging, and then we had China going into a significant slowdown and the Chinese currency facing a big devaluation, and the list just goes on, right? And so I think all this has really damaged, the outlook for the world economy. And what we are likely to see going forward is a world that is going to grow at a fairly slow pace. It's a world that's probably going to tread water. I would call it treading water, just staying afloat, right? It's not going to sink. We're not going to see a recession, but we're probably going to see growth growing at about 3% per annum, right? Is that bad news for investors? May not necessarily be. Because I will show you later a chart that shows you that, despite all this bad news I've painted, between 2009 and 2016, equity markets have gone up 160%. All right? So what the slow growth also means is that central banks are going to adopt very loose, very accommodative monetary policy. And thus far, that has been actually quite positive for risk assets like equities and even bonds. Right? They've all gone up a lot despite such not such a great outlook for the world economy. So going forward, I think things are not going to change. It's not just the after effects of the past shocks we're talking about. I think we also have serious structural impediments in the world. The world is aging, clearly aging quite significantly. We are seeing population declining, right? We are seeing productivity declining. We are seeing greater regulation in the financial sector that is also going to affect the ability of companies to raise capital. So there are a lot of other structural issues that are going to affect the world as well. And so I think going forward, we'll be lucky if we can get a growth of 3%, maybe 3.5% in terms of growth for the world. Historically, the world has grown as high as 5%, even 6%, but I think going forward, that's a new normal, that's a new paradigm, and I think that's got to sink into many of us, and it's not. I want to start by first talking about region by region. I'll start with the US economy and then go on to Europe and then go on to Japan and then go on to China before I go on to what it all means for the markets. So US economic outlook. I mean, this is probably the brightest spot in the world, in the developed world, right? If you look at unemployment rate in the US, it has improved significantly. The US unemployment rate used to be like 11%. Now it's down to below 5%. That's almost full employment. So if you look at the employment market in the US economy is doing fairly well. Now, if you look at wage growth in the US, that's also picking up quite nicely. I mean, wage growth in the US is hovering around 2.5%. And all indications from surveys of companies is that they're probably going to increase wages. Only problem is the wage growth is not picking up as fast as we want. But wages are important because, when wages improve, it means Americans have more money in their pocket. It means that they have more money to spend. And 70% of the American economy, 80% of the American economy is driven by consumption spending. So it's important that wages continue to go up for America to see a good outlook. If you look at business confidence, consumer confidence in the US, it points to the fact that it's relatively healthy. So there isn't a big confidence issue among, perhaps businesses and companies and individuals. If you look at consumer spending in the US, it is now running at the strongest rate in a decade or so. So consumers in the US are spending, right? Which is good for the economy because, like I said, 70-80% of the economy is driven by consumption spending. If you look at bank lending in the US, that's also picking up in a healthy way. I mean, we had the global financial crisis, we had the banks in trouble, but now the banks have kind of restored themselves. They're slowly starting to lend again. And why is this important? Because the banking system is the heart of the economy, right? So if banks don't lend enough money, I think, companies and individuals can't borrow enough. You will also see spending being affected, right? Corporate spending, individual spending also being affected. So bank lending is an indicator that I keep a very close eye on to give you an idea of, the outlook for the economy. If you look at real estate prices in the US, they've also picked up quite nicely. And this, again, is important. It's important because if Americans, their home prices go up, they feel richer, it also means that, they will spend more. This is what we call the wealth effect, right? When home prices go up, you feel richer, you spend more, good for America. And not just home prices going up that's good for America in terms of the wealth effect, it also means that developers will build more houses and properties, and that means more jobs. Okay, so the construction industry, the property industry in the US will create jobs which are good for the economy in the longer term. I think, like I said earlier, I mean, consumption spending in the US has been relatively strong. On that front, it's okay. But I think the weak spot in the US is really perhaps corporate spending. It could do better. All indications show, for example, this chart over here, it shows that corporate spending of late has been fairly weak, right? Companies are not spending maybe as much as they should. American companies are very cash rich, okay, but the problem with many of them is that they're using that money for share buybacks or mergers and acquisitions. So you're not seeing expansion really take place in a big way yet. And I think we need to see that take place in America in a bigger way for people to have confidence that, the recovery you see in America is on a firmer footing. So that's America. I think you are not seeing any kind of major trouble. The economy is probably going to grow at about 2%, which I think is quite decent. And America is quite important to every part of the world because, it's a major global driver. Europe is the other region I'm going to talk about now. And I think if you look at employment again, as a gauge of how Europe is doing, you can see unemployment rate in Europe has come off very significantly. Maybe not as much as America, but I think things are improving on that front. So the first thing I do when I look at, to assess whether economy is doing better or not, is to look at the employment market. And what you see in Europe is the employment situation improving. Maybe not ideal, but clearly improving. If you look at bank lending, that's another gauge of, the outlook. What you see is actually banks in Europe starting to lend again, right? So I think that's important. Like I said, if banks do not lend, then I think it's very hard for the economy to recover. And European banks clearly have problems, but you can see that, the chart is turned upwards and they are starting to lend again, which is a good indicator. If you look at the PMI numbers in Europe, you can see that they're holding up fairly well. Despite Brexit, we've not seen things collapse in Europe. Things will weaken a little bit, but, they're still holding up fairly well. So Brexit, I think, is a problem going forward, no doubt, but it hasn't dampened economic activity in Europe in a big way. But, I think it's too early to pronounce that Brexit is not going to have a big impact on Europe. Clearly, I think Brexit has just started. We've had a holiday, but, I think the UK Prime Minister has talked about invoking Article 50 by the end of March. And when that happens, we're not sure how things will play out. Whether the relationship between Europe and the UK will be acrimonious, or whether it's going to be a smooth divorce, right? So I think the markets will be wary of this. European companies will be wary of this. They will postpone investment decisions. They will delay investment decisions, and that is going to affect Europe to some extent. They may not pull the plug in a big way, but I think just the postponement alone is going to result in growth not being as spectacular as we'd like it to be. So Europe, I think things are improving, maybe not improving as much, and I think Brexit is a headwind for Europe. It's not going to cause Europe to fall off the cliff, but it is clearly a headwind that Europe is trying to deal with. Japan, I think Japan has been a story of ups and downs. Okay, you can see from this chart here, which is Japanese GDP, that basically, post-tsunami, everything went up. After tsunami, things came down. And then Abe took power, and there was a lot of optimism, and things went up again. And then Abe imposed a sales tax in April of 2014, and the economy came down again. And then the BOJ stepped in with a very loose monetary policy, and the economy picked up again. And now the yen has strengthened because of all the troubles in the world, and the economy is down again. So Japan has been a story of, a lot of ups and downs, and, that has left a lot of investors and forecasters disappointed about Japan because, it's one economy, one market that's quite difficult to forecast. If you look at unemployment rate in Japan, like I said, very often when I assess a country, I tend to look at the employment situation. If you look at unemployment rate in Japan, it is at a 20-year low. So you would tend to believe that, if you look at the employment market in Japan, the economy should be doing well. Yes, the unemployment rate is low. It's good and bad. Bad in the sense that in Japan, they are not as global as many other parts of the world. They don't welcome foreigners, foreign labor into Japan, right? So if the unemployment rate is this low, where are they going to find workers to grow the economy? So this is the problem. A low unemployment rate can be good and bad. And the bad is that finding workers is going to be a lot harder in Japan. But of course, the good is that because the unemployment rate is so low, you find that wages are likely to go up. And this is good for Japan because about 65% of the Japanese economy is driven by consumption spending. So if wages go up, clearly the Japanese have more money to spend. It's good for the economy in that respect. But if you look at business confidence among the major companies in Japan, it is still lacking, right? The Tankan survey, which basically gives you an idea of sentiment among Japanese big companies, it shows still a lot of weakness. So a lot of Japanese companies are very wary of the yen because the yen has been very, very strong. They have been budgeting with a yen of maybe 115 to the US dollar. But the yen is now like 102, 103 to the US dollar. So the yen has strengthened a lot more than Japanese companies think. And so I think that has affected their outlook, dampened their confidence to some extent. If you look at export volumes in Japan, it's clearly reeling from the yen. The strong yen is hurting exports in Japan. It's hurting the manufacturing sector in Japan. And I think Japan is really a story about the yen. Every time the Japanese yen weakens, you find the Japanese stock market just rallies. Every time the Japanese yen strengthens, you find the Japanese stock market, also is affected. The economy is affected. And unfortunately, we're living in very uncertain times now. The next 6 months, next 12 months is going to be very uncertain. And ironically, the Japanese yen is seen as one of the safest haven currencies in the world. So in times of uncertainty, the Japanese yen actually strengthens. So despite what the BOJ has done in terms of very loose monetary policy, which should have sent the yen weaker, what is happening now is the yen is strengthened because of enhanced global uncertainties. So that's Japan. Nothing spectacular, nothing very exciting to tell you about. It's treading water, it's going up, it's going down. The good news is that they appear to be gradually emerging from deflation, but they have serious problems. I think going forward, Abe needs to shoot its third arrow. He needs to start really undertaking serious reforms, like for example, allowing more foreigners to work in Japan. Allowing them to come into Japanese shores, work. I think the shortage of workers will affect the Japanese economy going forward. China, that's the big elephant in the room. You can clearly see the economy is slowing down. Industrial production used to be 14%, now it's like 6%, so the economy is clearly slowing down. And I think what's keeping the economy afloat is really a lot of government stimulus. Chinese government has pumped in a lot of money. Chinese banks are lending a lot of money, and I think that is helping the economy, right? But you all know that, in the longer term, that cannot go on forever, right? So, but the government seems quite intent on making sure that, they do whatever they can to keep the economy alive. There's a key Chinese Communist Party elections taking place in 2017, the end of next year. And clearly, I think the government wants to make sure that, they do whatever it takes to keep the economy alive because, otherwise you could see a leadership tussle within the Communist Party of China. And I think Xi Jinping is clearly trying his best to make sure things are okay so that come end 2017, when they renew leadership, they will give him another shot at another 5 years. And I think between now and 2017, you'll continue to see stimulus out of China to make sure that it doesn't crash and burn. But I think what is happening is also that because of what's really happening in China in terms of the slowdown in growth and all that, you've seen a lot of capital leaving China. Capital outflows in China in the last 12 months has been about $1 trillion US. That's a lot of money, right? And what's happened is that the Chinese central bank has been in the market trying to stem that outflow, the impact of that outflow on the currency. So they have done that by basically buying, the Chinese currency. and dwindling their reserves. So Chinese reserves have come down very significantly from something like $4 trillion to about $3.2 trillion. And from time to time, you have episodes of concerns about the Chinese currency. Like, for example, the last few days, I think the Chinese currency has started to weaken again. And everybody's worried that China will allow its currency to weaken once again. China just got admitted into the IMF SDR basket. And so the thinking is that, now that China is in the basket, it doesn't need to provide a lot of support to the currency, and so the authorities will let the currency slip. And then, of course, the Federal Reserve is going to hike rates, and that means that, the US dollar goes up, Chinese currency comes down. So I think the Chinese currency is going to pose problems for the Chinese government, and it'll be interesting to see how they deal with it. The other big problem in China is debt. They have a huge amount of debt. Like I said, the reason why they've grown at such a strong pace in the last few years is because, of debt. The government has basically thrown a lot of credit, a lot of debt at the economy. So there's been a lot of borrowings, but unfortunately, a lot of this debt has also not gone into the economy. It's gone into debt projects that have, not produced the kind of results that maybe it should have produced. Because for all this money that China has thrown at the economy should be growing at a much more rapid pace than 6%. But on the other hand, what we're seeing is really the economy slowing down. So there are fundamental issues. You have excess capacity. You have a debt overhang. You have an albatross, in China that's, going to weigh on the economy. So this is a big problem. And, I think the Chinese recognize it, which is why, the Chinese government has, through its newspapers, actually communicated that they want to deal with this problem. They have sort of swept this below the carpet previously, but now they are saying we have to deal with it. We have to bring debt down. For those companies that are very heavily indebted, that cannot survive, we have to let them, go. Let the zombies go. So I think there's this thinking within China that, you have to make that change. And you're starting to see that happening in China. In the onshore bond market in China, for example, you've seen an unprecedented number of defaults in China. In the past, I think some of these companies that were not doing well, the Chinese government continues to support them. But now I think there's a thinking that you have to let them go. Otherwise, you don't undertake reforms, and you cannot, go forward in a big way. So I think that's coming through in China. And clearly, when that happens, it's going to cause pain for the Chinese economy. So I don't see the Chinese economy really picking up steam in a big way to 7, 8%. You'll be lucky if it hovers around 6%, 6.5%. Lucky if it doesn't, go further south. So that's China. I mean, things are not looking fantastic, but I think because China is a controlled economy and because of the Communist Party's elections next year, I think they will do whatever it takes to make sure that, things are held together. Commodities, clearly, you've seen a rebound in commodity prices, but we don't think this rebound means that it's a turning point. We don't think that commodity prices are headed higher and you should jump in a big, big way. Oil, for example, we're not like bullish on oil. If you look at the fundamentals, US inventory levels are at record high. OPEC output is at a record high. Russian oil output is a record high. Russia is a major producer. And, so I think if you look at the supply side of oil, there's a huge amount of supply. Of course, from time to time, when OPEC talks about striking a deal, you could see oil prices rebound a little bit. But we don't see the prospects for oil prices or most commodity prices picking up in a big way. Bear in mind also that when the Federal Reserve hikes rates, the US dollar is going to head higher. And a stronger US dollar typically tends to weigh on commodity prices. So if you take a view that the dollar is headed higher, the US dollar is headed higher, then commodity prices may not appreciate as much going forward. So what does this mean for the investment outlook and your strategy? This is the chart I was telling you about. I mean, if you look at how the markets have done, in the last, from 2009 until now, despite all the negative news and headwinds and everything else I talked about, global equities have actually gone up by 154%. Okay, 154%. So if you're the kind of person who had actually sat by waiting for blue skies and good news to invest in the markets, you would have missed the boat, right? So unfortunately, the markets have done extremely well, and partly because of the weight of money. You have seen central banks throw a lot of money at the global economy to keep them alive, and that money has made its way into property prices, stock prices, push a lot of them up. But I think henceforth, can money continue to drive prices higher? Can liquidity continue to drive prices a lot higher from here? I think the answer is no. Question marks are being raised about the effectiveness of all this QE and monetary policy from the central banks, right? I think what we need to see now is growth. Going forward, you clearly need to see growth, and unless that comes true, you're not going to see prices go up as much as they have in the last few years. So if you look at the earnings picture for the next this year and next year, it is not looking pretty. I mean, you're not seeing strong earnings growth. You're seeing lackluster earnings growth. And if you look at valuations for the stock markets, what it tells you is that, stock markets are not exactly a screaming buy, right? I mean, the valuations are not a screaming buy at this juncture, right? Because they are like one standard deviation above the mean. Typically, anything that's 1 or 2 standard deviations above the mean means that, valuations are starting to look a bit stretched. But I think if you are a medium-term investor, in other words, looking out over the next 3 years, 4 years, then the valuations are still okay. But the next 1-2 years, the valuations look a bit stretched. So if you're a medium-term investor, I think there's still a case for putting some money into equity markets. And I think if you look at the Singapore stock market, right, you can see that the growth prospects in Singapore are not very exciting. Okay, but what's exciting about Singapore to a lot of foreign investors is really the fact that Singapore is a yield play. A lot of yield stocks over here, a lot of companies that offer you good yield. Corporate governance has improved quite a lot in Singapore. Companies are paying out dividends, and I think that's a good thing. So, like I said, the major central banks are going to adopt very loose monetary policy. I think this is not going to change. And I think this is probably one source of support for the downside, right? So you're not going to see prices plunge, even if there's a crisis, unless it's a systemic crisis, because central banks are going to adopt very, very loose policy. I don't see the Federal Reserve hiking rates in a big, big way. There isn't a case for them to do that. And so interest rates are going to stay low for, I think, quite a number of years going forward. We are talking about a low interest rate, low return environment going forward. And if you look at expectations about the Fed fund rate, I think it's been coming down. 2 years ago, people were expecting Fed fund rates to go up a lot, but I think now it's starting to come down. I think nobody expects the Fed to do anything too dramatic. Fed is probably going to hike rates, but nothing too dramatic. And the long bond yield as well. I mean, what it tells you is basically that, the bond markets see interest rates as being very muted, very subdued, going forward. Okay, so what does all this mean in summary? I think stocks and bonds have posted exceptional returns, right, in the last 7-8 years. And they've been helped by very loose monetary policy, right? Very, very loose monetary policy. But I think after the strong gains, capital upside is going to be limited. Because I think investors will refocus on growth because money alone is not going to drive markets a lot higher. And from what I've told you so far, growth is not going to be spectacular. We are talking about a very low growth environment going forward, right? So don't expect anything spectacular on the growth front. Earnings growth or economic growth. And I think, global growth is going to stay fairly low, fairly muted for quite a long period of time. Because we're still reeling from the after effects of all the crises in the last few years. Plus, on top of that, there are structural problems, demographic issues, low productivity, declining populations, and a host of other factors, tighter financial regulation, and all these are going to weigh on global growth going forward. We're not going to sink, but I think we're going to see a period of basically just going sideways. And I think the good news maybe is that central banks are all ready to print more money, ready to support the global economy. So I think that's a slight source of comfort. You're not going to see things, slipping through the cracks in a big way and, crashing. So there will be some liquidity support from the central banks. They all have come out to say that they will do whatever it takes. And I don't think the Fed is going to do anything too dramatic either. So I think the double-digit gains that we've seen in the last few years, we have to be realistic. It is not going to happen going forward. I think a lot of us are very used to making double-digit returns. But I think going forward, given the growth environment I talked about, I think we have to change our mindset. We'll be happy with, maybe 5%, 7%, 8% returns if you can make that sort of returns. I think we need to change our mindsets. And clearly, I think you cannot just focus on capital upside. I think yield is very, very important because I think with the interest rate staying very low, investors will search for yield. And companies that offer you yield, investments that offer you yield, as long as they're good investments, I think will be sought after. So I think going forward, when you invest, two things. One is, given the growth outlook, moderate your expectations. You're not going to be able to make 15, 20% growth. If you're able to make that kind of growth, you're taking on a lot of risk, right? But from a strategic perspective, from a long-term perspective, if you can make single-digit returns, high single-digit returns, you'll be lucky. And of that high single-digit returns, a significant portion of that has to come from dividends, has to come from yield. So if you can make maybe 5%, 7%, 8%, I think that's already very, very good, right? Of course, you're going to be able to make 20, 25%. That is if you see the markets pull back sharply. For example, if Trump wins and the markets fall 10, 15%, and you are the kind of investor who has a risk appetite, and you go in there and you buy at the bottom, and then you ride the way up when sentiment improves, then you can make maybe 20, 25%. But if you talk about from a long-term strategic perspective, I think single-digit returns are probably the way to go. So I think it's very, very careful. I think in the current environment, as we look forward, there's a lot of risk that's going to be out there in the markets. You've got political risk. Next year, for example, you've got a lot of elections taking place in Europe, right? Lots of elections taking place in Europe. Pushback against globalization. You've got the Fed probably going to hike rates. So Brexit is going to start gathering pace. So there are going to be a lot of challenges in 2017. We're not going to see a big rebound in the economy. We're not going to see all this uncertainty go away anytime soon. So being very careful with the investments is very, very important in this kind of environment. And that means, I think it's important to diversify, not to fall in love with any one stock, one investment, one asset class. Very important to diversify. There's a difference between excitement and investment. And I think if you are looking for investment, then it may not be the most exciting thing, but it produces you good returns in the long term. But if you're looking for excitement, then, maybe the markets are not the best place for you. I think it's important to draw a distinction between the two of them. And next year is going to be a difficult year for the economies and the markets. And I think it's very important to track carefully and important to diversify. And so I think you're going to see a lot of volatility next year. And I think it's very important to be very careful in the way you invest. And what I would suggest is if you're looking to invest in the markets, maybe to phase your investments in. In other words, to put it in over time, over the next 6 months, 12 months, maybe even 18 months. Because that way you don't fire all your bullets. You have some dry powder. If the markets still pull back, then you're able to still go in there and buy a little bit. So in other words, buy slowly, buy gradually, and don't just buy one or two things, but buy different asset classes and diversify. So with that, I thank you very much, and I hand you back to Richard.